The global debt cycle doesn't end because people decide it should. It ends because the math stops working. For years, debt has expanded faster than income across governments, corporations, and households, creating a system that relies on constant refinancing rather than real repayment. This is what defines a late-stage debt cycle. The problem isn't simply that debt levels are high. It's that the capacity to service that debt depends on continued growth, low interest rates, and stable confidence. All happening at the same time. When any one of those conditions weakens, stress begins to surface in places most investors aren't watching. What makes the current cycle particularly dangerous is how normalized debt has become. Borrowing is no longer seen as a temporary tool to bridge downturns, but as a permanent feature of economic management. Governments roll over massive obligations instead of reducing them. Corporations issue debt not to invest in productivity, but to buy back shares and support asset prices. Consumers rely on credit to maintain living standards that wages alone can no longer sustain. This creates an environment where debt feeds asset inflation, and asset inflation justifies more debt, reinforcing the cycle. As interest rates rise or even remain elevated, the cost of servicing this debt grows exponentially. Small changes in rates create outsized effects because the base level of borrowing is so large. What once looked manageable under near rates becomes a structural burden. Governments face higher interest expenses that crowd out spending on growth. Corporations see margins compressed. Households become more sensitive to economic slowdowns. These pressures don't break the system immediately, but they steadily reduce flexibility, leaving fewer options when shocks occur. Another critical issue is that much of this debt is interconnected. Sovereign debt sits on bank balance sheets. Corporate bonds are held by pension funds and insurance companies. Household debt supports housing markets that underpin financial stability. When stress appears in one area, it transmits quickly through the system. This is why late-stage debt cycles rarely resolve in isolation. They unwind across multiple sectors, often forcing policymakers to choose which parts of the system to support and which to allow to adjust. Historically, there are only a few ways these cycles end. Debts are restructured, inflated away, defaulted on, or suppressed through financial repression. Each path carries costs, and none are painless. Inflation reduces the real value of debt, but erodes purchasing power and destabilizes currencies. Defaults damage trust and contract credit. Repression distorts markets and punishes savers. The common thread is that someone absorbs the loss. The idea that debt can grow indefinitely without consequences has never held up over long periods of history. What makes the current moment more complex is the global synchronization of debt. In past cycles, problems in one region could be offset by strength in another. Today, most major economies are running large deficits at the same time, limiting the ability for external support. This creates competition for capital and increases the temptation to use monetary tools to manage fiscal problems. When multiple countries pursue similar strategies, the system becomes more sensitive to shifts in confidence, particularly around currencies and interest rates. Investors often assume that because governments can create money, debt is less risky at the sovereign level. While it's true that governments with monetary control can avoid outright default, they cannot avoid the economic consequences of overextension. Printing money changes the value of money itself. It redistributes wealth rather than creating it over time. This undermines confidence in the currency and alters behavior in ways that are difficult to reverse. Capital seeks protection, and that movement reshapes markets. A late-stage debt cycle is not defined by collapse but by constraint. Choices become harder, trade-offs become unavoidable, growth becomes more dependent on stimulus rather than innovation. Asset prices become more sensitive to policy signals than fundamentals. This is the environment we are entering. The warning is not about timing a crash, but about recognizing that the system's margin for error is shrinking and that leverage which once amplified gains can just as easily amplify losses when conditions change for decades. Central banks have been seen as the ultimate backstop, the force that steps in when markets wobble and confidence begins to crack. That belief has shaped investor behavior, encouraging risks, taking under the assumption that monetary authorities will always intervene in time and at sufficient scale. But the environment that allowed central banks to operate so freely no longer exists. The conditions that made aggressive intervention effective in the past have changed, and that change is one of the most underappreciated risks moving forward. In earlier cycles, central banks had the luxury of fighting recessions without worrying much about inflation. When growth slowed or markets seized, interest rates could be cut aggressively. Liquidity could be injected, and asset prices could be stabilized without immediate backlash. Inflation remained contained, allowing policymakers to prioritize growth and financial stability. That balance has shifted. Inflation is no longer a distant threat. It is a visible and politically sensitive reality. Every decision to ease now carries the risk of reigniting price pressures, eroding purchasing power, and undermining public trust. As a result, central banks are constrained in ways investors are not accustomed to. Raising rates to fight inflation tightens financial conditions and exposes leverage throughout the system. Cutting rates to support markets risks, signaling that price stability is no longer the priority. Expanding balance sheets supports asset prices but weakens currencies and fuels inequality. Each tool now has sharper and more immediate consequences, reducing the ability to respond decisively when stress emerges. This creates a dangerous mismatch between expectations and reality. Markets are still priced as if central banks have unlimited capacity to smooth volatility and prevent deep drawdowns, but policymakers are increasingly forced to choose between conflicting objectives. Protecting the financial system may come at the cost of higher inflation. Containing inflation may come at the cost of market instability. There is no solution that satisfies all sides, only trade-offs that redistribute pain. Another limitation is credibility. Central banks rely not just on tools, but on trust. Their ability to guide behavior depends on the belief that their actions will produce the intended outcome. When inflation persists despite tightening, or when growth weakens despite easing, that credibility erodes. Investors begin to question forward guidance, households adjust expectations, wage demands rise, long-term interest rates respond independently of policy signals. At that point, central banks are no longer leading markets, they are reacting to them. Debt levels amplify this problem. With so much leverage in the system, small policy moves can trigger large reactions. A modest rate increase can strain government budgets, destabilize housing markets, or pressure over-leveraged companies. Conversely, holding rates too low for too long misprices risk and encourages further borrowing. Central banks are forced into a narrow corridor where every step risks hitting a wall on either side. There is also the political dimension. As monetary policy decisions increasingly affect everyday living costs, they become harder to separate from public pressure. Central banks may be independent in theory, but they operate within societies that feel the consequences of their actions directly. Rising unemployment, falling asset values, and higher borrowing costs create demands for relief. This makes long-term discipline more difficult to maintain, especially when short-term pain is visible and concentrated. The global nature of modern finance further reduces policy effectiveness. Capital moves quickly across borders, responding to yield differentials and currency expectations. Actions taken by one central bank spill over into others, forcing reactions that may not align with domestic conditions. Coordination becomes harder as national priorities diverge. In such an environment, monetary policy loses precision and gains unintended side effects. The result is a system where central banks are still powerful but far less omnipotent than commonly believed. They can influence conditions, but they cannot eliminate cycles. They can delay adjustments, but they cannot prevent them. As their room to maneuver narrows, volatility becomes more likely, not less, because the margin for error is thinner and the cost of mistakes is higher. Complacency rarely feels like risk while it is happening. It feels like comfort, like normally, like the belief that the system has adapted and that past dangers no longer apply. This is why periods of apparent stability are often the most fragile. When investors grow accustomed to steady returns, shallow drawdowns, and predictable policy responses, they begin to underestimate uncertainty. Risk doesn't disappear in these moments. It simply becomes hidden beneath confidence and repetition. One of the clear signs of complacency is the widespread belief that volatility has been permanently tamed. When market declines are quickly reversed and disruptions are met with swift intervention, investors learn to buy every dip. Over time, this behavior becomes reflexive rather than analytical. Assets are purchased not because their underlying value is compelling, but because of the expectation that prices will be supported. This creates feedback loop where optimism reinforces itself even as fundamentals quietly deteriorate. Another indicator is the narrowing of perceived risk. Investors focus intensely on a small set of variables while ignoring others that are harder to measure. Earnings growth, interest rate decisions, and short-term economic data dominate attention, while balance sheet health, leverage, and long-term incentives receive less scrutiny. This selective vision makes the system more vulnerable because the most damaging risks are often those that develop slowly and escape immediate notice. Complacency also shows up in the language investors use. Terms like "this time is different" or "structural shift" appear when traditional valuation metrics are dismissed. High prices are justified by new narratives, and caution is framed as outdated thinking. The longer markets move in one direction, the stronger these narratives become. They create social pressure to conform, making it difficult to step back without feeling irrational or early. As confidence rises, safeguards are gradually removed. Leverage increases because losses seem unlikely. Liquidity buffers shrink because capital feels idle. Risk management is optimized for efficiency rather than resilience. These decisions make sense individually, but collectively they weaken the system. When conditions change, there is less margin for error, and adjustments that could have been gradual become abrupt. The illusion of stability is reinforced by the complexity of modern markets. Risk is often dispersed through derivatives, structured products, and interconnected financial institutions. This gives the impression that exposure has been managed and distributed. In reality, complexity can obscure true concentrations of risk. When stress emerges, correlations that were assumed to be low suddenly rise, and protections that appeared reliable fail simultaneously. Investor complacency is not limited to individuals. Institutions, too, are subject to the same behavioral patterns. Performance benchmarks encourage short-term thinking. Career risk discourages deviation from consensus. When everyone owns the same assets, underperformance feels safer than being wrong alone. This leads to crowded positions that are stable only as long as inflows continue. The most dangerous aspect of complacency is that it dulls the ability to imagine alternative outcomes. Scenarios that involve policy mistakes, geopolitical shocks, or sudden shift in confidence are acknowledged in theory but discounted in practice. They are assigned low probabilities not because they are unlikely, but because they are uncomfortable. As a result, portfolios are built for a narrow range of outcomes in a world that rarely delivers them. Fragility emerges when expectations and reality diverge. A system optimized for calm becomes vulnerable to surprise. Small shocks that would have been absorbed in a more resilient environment instead cascade through leverage, liquidity constraints, and forced selling. What felt like stability reveals itself as dependency on favorable conditions. This is why complacency is not merely a psychological flaw, but a structural risk. It shapes how capital is allocated, how systems are designed, and how responses are prepared. When confidence replaces caution, the surface looks smooth, but the foundation becomes thin, and it is precisely in these moments that the potential for disruption grows unseen. The global landscape is shifting away from integration toward fragmentation. And this transition carries profound implications for investors. For decades, economic growth was supported by expanding trade, open capital flows, and the assumption that efficiency mattered more than resilience. That framework is now being challenged. Nations are reassessing dependencies, prioritizing security over cost, and redefining relationships through a geopolitical lens. These changes are not temporary reactions. They represent a structure realignment that alters how capital moves and how markets behave as trust between major powers erodes. Economic decisions increasingly reflect political considerations. Trade policies are no longer designed solely to maximize growth, but to reduce vulnerability. Supply chains are shortened, duplicated, or redirected, often at higher cost. This shift introduces persistent inflationary pressure as efficiency gain that once lowered prices are sacrificed for redundancy and control. Investors accustomed to disinflation driven by globalization must adjust to a world where prices are influenced by strategy as much as by supply and demand. Capital flows are also becoming more selective. When geopolitical alignment matters, investment flows, political stability, and alliance structures rather than pure return potential. This can create uneven development with capital concentrating in regions perceived as safe while avoiding those viewed as uncertain regardless of underlying fundamentals. Such patterns increase volatility and reduce the benefits of global diversification that investors have relied on for decades. Currencies sit at the center of this transformation. When global cooperation weakens, confidence in reserve systems is tested. Nations seek to reduce reliance on external currencies, build alternative settlement mechanisms, and hold reserves in forms that are less exposed to political risk. These efforts don't overturn existing systems overnight, but they gradually chip away at assumptions that once seemed unshakable. Currency volatility becomes more pronounced as economic and political forces intertwine. Geopolitical fragmentation also complicates policy coordination. In earlier periods, shared challenges encourage joint responses that stabilize markets. Today, divergent priorities make cooperation harder. Actions taken by one country to protect its interests can create spillover effects elsewhere, prompting retaliatory measures that amplify instability. This dynamic reduces the effectiveness of traditional policy tools and increases the likelihood of unintended consequences. For investors, one of the most significant risks is misreading the pace of these changes. Geopolitical shifts unfold over years, not weeks, making them easy to dismiss in the short term. Markets often continue functioning as if the old rules still apply, even as the foundations are being reworked. This creates a gap between pricing and reality that widens gradually then corrects abruptly when a trigger exposes the underlying tensions. Another challenge is that geopolitical risk does not fit neatly into models. It resists quantification and behaves asymmetrically. Small events can have outsized effects while large developments may be absorbed quietly. This unpredictability makes portfolios that rely heavily on historical correlations more vulnerable. Assets that once moved independently may begin reacting to the same geopolitical signals, reducing diversification when it is needed most. The reshaping of global markets also affects corporate behavior. Companies edge strategies to navigate tariffs, regulations, and political scrutiny. Investment decisions prioritize jurisdictional safety and regulatory clarity. Profit margins are influenced by compliance costs and supply chain restructuring. These changes alter earnings dynamics in ways that traditional analysis may underestimate. Geopolitical fragmentation doesn't eliminate opportunity, but it changes where and how opportunity appears. It rewards adaptability, local knowledge, and an understanding of political incentives. At the same time, it punishes overconfidence in stability and assumptions of continuity. Markets are being reshaped not by a single shock, but by a steady accumulation of strategic decisions that redefine risk return. And the flow of capital across borders. Periods of strong market performance often hide the buildup of concentration risk. Capital tends to flow toward what has worked most recently, reinforcing winners and amplifying narratives that justify continued inflows. Over time, a growing share of returns becomes dependent on a narrow group of assets, sectors, or strategies. This concentration feels efficient while trends persist, but it creates fragility beneath the surface that is often ignored until conditions change. One of the drivers of concentration is benchmarking. Investors are measured against common indices, which themselves become more concentrated as the largest assets grow. To avoid underperforming, managers allocate more capital to the same names regardless of valuation or risk. This behavior pushes prices higher, attracting even more capital and reinforcing the belief that these assets are uniquely resilient. The result is a market where perceived safety and popularity become indistinguishable. Liquidity plays a central role in this dynamic. As assets rise and attract inflows, trading appears smooth and efficient, spreads are tight, and price movements feel controlled, but this liquidity is conditional. It depends on continued demand. When sentiment shifts, the same assets that seemed easiest to trade become difficult to exit because everyone is positioned the same way. Liquidity evaporates precisely when it is most needed. Technology and passive investing have accelerated this process. Automated strategies allocate based on momentum, market capitalization, or predefined rules, not judgment. While this increases efficiency in stable conditions, it also amplifies herd behavior. When markets move, these strategies reinforce trends in both directions, increasing correlation and reducing the diversity of responses that once dampen volatility. Concentration risk is not limited to equities. It appears in fixed income markets where demand clusters around certain maturities, issuers, or credit qualities. It shows up in real assets where capital crowds into perceived inflation hedges. It emerges in alternative investments where similar structures and assumptions dominate. In each case, the appearance of diversification masks a deeper alignment of risk factors. The danger of concentration becomes evident during stress. Small shocks trigger disproportionate reactions because prices are supported by positioning rather than fundamentals. As losses appear, leverage magnifies them. Margin calls for selling. Risk models adjust, prompting further reduction. What began as a modest revaluation turns into a rapid unwind driven by mechanics rather than analysis. Another overlooked aspect is narrative concentration. Markets often revolve around a few dominant stories that explain and justify prices. These narratives simplify complexity and provide confidence. But when reality diverges from the story, confidence erodes quickly. Assets that were valued on belief rather than cash flows or resilience face sharp repricing as the narrative collapses. Regulatory and structural factors can intensify these effects. Capital requirements, risk weighting rules, and accounting standards influence where institutions hold assets. When many participants respond to the same constraints, positions align. Disalignment reduces systemic resilience and increases the likelihood of abrupt adjustments when conditions change. Concentration also affects market leadership. When a small group of assets drives overall performance, the broader market becomes less reflective of economic health. Weakness in leadership can ripple outward even if other areas are fundamentally sound. This creates a misleading sense of stability that can reverse suddenly. The core risk of concentration is not that popular assets will necessarily fail, but that their dominance leaves little room for error. When expectations are high and positioning is crowded, even small disappointments can have outsized effects. Markets that rely on a narrow base of support are inherently unstable, and when that support shifts, the adjustment tends to be swift and unforgiving. Periods of major transition tend to reward those who focus less on forecasting precise outcomes and more on building resilience. The instinct to predict exact timing, exact catalysts, or exact market levels is understandable, but it often leads to overconfidence. Cycles are complex systems shaped by countless variables interacting at once. They do not unfold according to clean narratives or linear models. What can be understood, however, is how systems behave under stress and what tends to survive when conditions deteriorate. Preparation begins with accepting uncertainty rather than fighting it. Many investors build portfolios around a narrow range of expectations, assuming continuity and growth, policy support, and market structure. When those assumptions hold, results feel stable. When they break, losses compound quickly. A resilient approach acknowledges that multiple futures are possible and that the cost of being wrong can be far greater than the cost of being cautious. True diversification is often misunderstood. It is not about owning many assets, but about owning assets that respond differently to the same environment. Holding positions that all depend on liquidity, low inflation, or stable growth creates the illusion of safety while concentrating exposure to a single regime. Behavioral diversification focuses on how assets perform when inflation rises, when growth falls, when confidence breaks, or when capital controls tighten. This perspective shifts the goal from maximizing returns in good times to preserving optionality in bad times. Risk management is another critical element of survival, yet it is frequently deprioritized during extended periods of calm. When volatility is low and drawdowns are shallow, protection feels unnecessary and expensive. Over time, safeguards are reduced, leverage increases, and buffers are minimized. This makes portfolios efficient but brittle. When conditions change, the absence of protection forces reactive decisions under pressure, often at the worst possible moments. Respect for historical cycles provides context that short-term data cannot. While no two periods are identical, the patterns of debt accumulation, policy, response, speculation, and correction repeat with remarkable consistency. Ignoring these patterns does not prevent their consequences. Understanding them does not guarantee avoidance, but it improves positioning. History does not offer precise forecasts. It offers probability ranges and warning signs. Psychological discipline is just as important as structural preparation. During periods of stress, fear, and greed intensify. Decisions become emotional. Those who have not prepared mentally are more likely to abandon plans, chase losses, or liquidate at unfavorable prices. A resilient strategy is one that can be maintained under pressure, not one that looks optimal on paper during cal periods. Liquidity deserves particular attention. In theory, many assets appear liquid. In practice, liquidity is conditional. It exists when it is least needed and disappears when demand becomes one-sided. Maintaining access to truly liquid resources provides flexibility and reduces dependence on forced actions. Liquidity is not a drag on performance in unstable environments. It is a form of insurance against bad timing. Another aspect of preparation is humility toward policy responses. While authorities can influence outcomes, they cannot eliminate trade-offs. Relying on intervention as a primary risk control substitutes analysis with hope. Resilient approach assumes that policy actions may be delayed, insufficient, or produce unintended consequences. This mindset encourages self-reliance rather than dependency. Survival through major transitions is rarely about making one bold move. It is about a series of disciplined decisions that prioritize durability over excitement. It involves accepting lower returns in favorable periods in exchange for the ability to endure unfavorable ones. Those who emerge strongest are not those who avoided all losses, but who remained intact and positioned when opportunities reappeared. Cycles do not reward certainty, they reward adaptability, balance, and patience. When systems shift, the advantage belongs to those who planned for change rather than those who assumed stability will persist. Because in every major transition, the defining difference is not who was the smartest, but who was prepared to last. Through it, all of these forces point to the same reality. We are not standing at the edge of a single event, but moving through a transition that reshapes how markets function, how risk expresses itself, and how capital is rewarded. High debt, constrained policy, complacent positioning, geopolitical fragmentation, and concentrated exposure are not isolated problems. They reinforce one another together. They create an environment where small shifts can produce outsized consequence and where assumptions that once felt safe quietly lose their reliability. This is how major adjustments begin, not with collapse but with pressure, not with panic but with imbalance. The most costly mistakes are rarely made during the downturn itself. They are made years early when signals were visible but dismissed because conditions still felt comfortable. The coming period will test more than asset selection. It will test discipline, patience, and the ability to operate without the reassurance of certainty. Those who navigate it well will not be the ones chasing headlines or searching for perfect forecasts. They will be the ones who question consensus, reduced hidden fragility, and built portfolios designed to endure a wider range of outcomes. They will understand that resilience is not defensive pessimism, but strategic realism, and that protecting capital during unstable phases creates the freedom to act when opportunities emerge. This is the moment to step back and reassess what you own, why you own it, and how it behaves when conditions turn against you. To examine where confidence has replaced analysis, where familiarity has replaced diversification, and where leverage has quietly narrowed your margin for error. The future will not reward comfort. It will reward those who prepared before preparation felt necessary, who studied cycles instead of narratives, and who chose durability over short-term approval. Because when the next phase reveals itself fully, readiness will matter far more than reaction.